and welcome to our webinar on 30 June 2019 reporting considerations. I'm Kim Heng and I will be your host for today's webinar. I'm a partner in our Department of Professional Practice. It's a group that helps clients and KPMG staff with interpreting and applying IFRS and other financial reporting requirements. Joining me on this webinar today is Ben Sumahu, a Director, and Kristen Haynes and Julie Locke, Senior Managers within the firm. This slide helps put our webinar topics in context. You could be thinking that as it relates to financial reporting and regulatory matters that we are in the eye of the storm. Pressure is building from many sides, some threatening significant impacts. The AASB continues to be busy, having recently released its updated version of the paper, Climate-Related and Other Emerging Risks Disclosures, Assessing Financial Statement Materiality Using AASB and IASB Practice Statement 2. This paper indicates that given investor statements about the importance of climate-related risks to their decision-making, entities can no longer treat climate-related risks as a matter of corporate social responsibility only and should consider them also in the context of their financial statements. Additionally, the AASB continues on its path of implementing the revised conceptual framework in Australia. Decisions have been taken to dismantle the reporting entity concept for entities preparing financial statements under legislative requirements, for example, such as the Corporations Act, and do away with the ability to prepare special purpose financial statements for these purposes. Although implementation of any outcome is a couple of years away, we are expecting an exposure draft on this significant change and flow-on impacts to be issued in the second half of this calendar year. Coupled with this is the doubling of the thresholds in the Corporations Act for when proprietary companies assess whether they are large or not, and therefore prima facie whether they have a statutory obligation to prepare, have audited and lodge financial statements with ASIC. This regulation was enacted in early April to be effective for financial years beginning on or after 1 July 2019, so it will impact next year in 2020. Also, last month, after a lengthy wait, the ATO issued its updated guidance for significant global entities that are required to lodge general purpose financial statements, where such financial statements are not lodged with ASIC for statutory purposes. This guidance has provided clarity around some of the outstanding issues with the original legislation and guidance that was issued back in 2017. Staying with taxation and transparency matters, the Board of Taxation performed a post-implementation review of its voluntary tax transparency code and recommended further changes to enhance disclosures around the various tax numbers reported by entities in reports and those released by the ATO. The tax transparency code itself continues to be voluntary though. Whilst not effective until years beginning 1 January 2020, we have also seen the ASX issue the 4th edition of Corporate Governance Principles for Listed Entities, which contains 8 new recommendations. While taking out the contentious word social licence that was in the draft principles, the concept remains that companies have to take account of reputation and community standing in their operations. That is, business cannot simply concentrate on making profits to exclusion of other issues. And ASIC continues its various surveillance activities. Given some of the sentiment that has been raised in the various inquiries, and in particular the amount of media attention around how the regulator is not tough enough on corporates and big business, we are expecting to see ASIC shift to a more combative culture, including how they deal with financial reporting surveillance and audit inspection issues. With this all in mind, let's look at our agenda for today. In today's webinar, Kristen will discuss the new accounting standards effective for the first time for 30 June 2019 reporting. Julie will take you through a few topical issues that we are seeing our clients dealing with that will be worth your consideration this reporting season. Ben will take you through what our regulators are concerned about and also discuss what's coming up. And then I'll come back and wrap things up and respond to your questions. I'll now hand you over to Kristen.
Thanks, Kim. So the adoption of the 3 new major standards, AASB 9 Financial Instruments, AASB 15 Revenue from Contracts with Customers, and AASB 16 Leases, is not surprisingly going to be the main focus for you all as you approach this 30 June reporting season. However, it is important to be aware of a few other minor changes that are also coming to effect for the first time this 30 June and ensure that they are not overlooked as you prepare your financial reports. So let's have a look at what those changes are. For entities that are coming up for the year ends at 30 June, on top of the new financial instruments and revenue standards, there are a few minor amendments. AASB 2016-5 made some minor amendments to share-based payments accounting, but as it relates to the treatment of employee withholding tax, which we do not even have in Australia, and some other minor amendments relating to modifications, it's not expected to have a significant impact here. AASB 2017-1 was the main amendment as part of the annual improvements process, and it clarifies that to move a property either into or out of being an investment property, you can only do so when there is clear evidence of a change in use and that it is not a free choice. The amendments to the insurance contract standards primarily focused on the deferral of the application of AASB 9 for those entities until they adopt the new insurance standard as well. The main change here to note, though, is Interpretation 22, Foreign Currency Transactions and Advance Consideration. Let's take a moment to look at that in more detail. This interpretation is relevant where you're dealing with transactions in foreign currencies and you receive or pay that consideration in advance of receiving or providing the good or service. For example, prepaid expenses or accrued revenue. The interpretation makes it clear that once you have translated the foreign currency amount on the initial receipt or transfer of cash, you do not retranslate again at the latter date when the actual item is recognised. So let's have a look at what this might mean in practice. Let's say you are prepaying an expense in USD of $100. At the date that we make that payment, we recognise a prepayment asset on our balance sheet of 150 AUD based on the spot exchange rate at that date. Sometime down the track, we actually incur that $100 USD expense and we recognise it in the income statement. If we became aware that there were two ways in practice that people were recognising this expense. Some people would retranslate that USD expense at the current spot rate. In this example, they would recognise an expense of AUD $130 with an FX loss of $20. Other people would just recognise the expense at the original 150 AUD that they had already recognised on their balance sheet as a prepayment. Basically, what IFRIC confirmed was that you should not be retranslating that USD $100 and instead just recognising the expense at the $150 that you had previously booked. Based on our understanding and discussions that we've had with clients, we don't think this is going to have a significant impact in Australia, as most entities tended to already recognise the expenses at $150. However, if you're not sure what you are currently doing, it would be worthwhile checking and ensuring that you're complying with this new interpretation. Alright, so now let's have a look at what those of you who are approaching half year need to be thinking about. On top of applying the new leasing standard for the first time, you also have a suite of minor amendments to consider. Interpretation 23 we discussed in detail during our 31 December 2018 webinar, so I don't intend to discuss it today, other than to remind you that if you do have uncertain tax treatments that have not yet been accepted by the ATO, you should be considering this interpretation to ensure that your accounting is appropriate. If you do want a refresher on the details, please refer back to the last webinar, as it is possible that you will need to recognise provisions for uncertain tax positions earlier than you currently do. Also, as part of the Annual Improvements Project, AASB 2018-1 was issued, and it makes amendments to AASB 3 Business Combinations and AASB 11 Joint Operations to clarify that when you have a transaction that increases your interest in a joint operation, you only revalue your existing interest to fair value when the transaction results in you gaining control and is accounted for as a business combination. AASB 2017-6 relates to prepayment features as negative compensation, and AASB 2018-2 relates to plan curtailments or settlements. These are not expected to have a significant impact in Australia, as we don't typically see many arrangements for these features. However, if you do have defined benefit pension plans and you have curtailments or settlements happening, be mindful, as these amendments may have a significant impact. Also, if you are a not-for-profit on the line, although you won't be preparing half-year accounts, if you're a December year-end, don't forget that you are already in the period of adoption for AASB 1058, income for not-for-profits, and there is also updated guidance out there on the right-of-use assets for not-for-profits as well. Let's consider these amendments relating to long-term interests in associates and joint ventures in more detail. These amendments are going to be most relevant to entities in the real estate sector or extractive industries who typically have more complex joint arrangement structures. Your investment in your associate or an equity accounted JV may comprise of two things. Firstly, your ordinary shares which you equity account for, and then you may also have other investments such as long-term receivables where repayment is not expected in the foreseeable future. Whilst these long-term receivables are accounted for at amortised cost and not equity accounted, they still form part of your long-term interest in the associate. This is really important if the associate is loss-making to the extent that the equity accounted investment has been reduced to nil in your balance sheet. Under the equity accounting requirements of AASB 128, any further losses of the associate should be absorbed by the other long-term interests in the entity, such as these long-term receivables. However, the question arose as to how does this interact with the impairment requirements under AASB 9, as after all, these receivables are financial instruments. Whilst historically there has been mixed practice, these amendments confirm the appropriate approach to take. First, you apply the normal impairment model under AASB 9 to these receivables and determine if there is any expected credit loss. It's only after that ECL has been recognised that you will consider the allocation of any additional equity accounted losses to these long-term interests. These long-term interests will continue to absorb these losses until they are also written down to nil. That was all I wanted to cover today on the minor amendments, and now I want to have a short discussion about the three new standards that I am sure you're all busily working away on the application of. By now we've been through the December reporting season and have had a chance to see what some of those December year-end reporters have been doing and can reflect on what that means for your 30 June accounts. It'll be of no surprise to you that we expect that the application of the three new standards to be a major focus area for ASIC. It's important to note that ASIC's focus is as much on the disclosures associated with the new standards as it is going to be on the recognition and measurement. I think it would be fair to say that for a number of you, the application of the new financial instruments and revenue standards may have not had the impact that we initially told you to brace for, but that's no reason to get complacent. Both standards have new disclosure requirements and you're going to need to incorporate these into your 30 June accounts. Some of these are transitional disclosures and some of them are going to be new ongoing ones. Please don't underestimate the effort that is going to be required to collate this additional information. Let's first look at financial instruments. There are disclosure considerations here both on transition and on an ongoing basis. My comments relating to transition are not complex, but it's really important to make sure that you get it right. First, let's look at your accounting policy. Although nothing may have changed in the way you book your debits and credits, your accounting policy still needs to be updated to reflect the approach and terminology of the new standard. In reviewing clients' accounts, I've seen people still refer to incurred losses in discussing their approach to impairment, rather than talking about the forward-looking expected credit loss model. In addition, I've still seen people refer to their available-for-sale financial assets. This is still old terminology and accounting policies should be updated to reflect that these instruments are now fair value through OCI, with further elaboration depending on whether they are debt or equity instruments. You should also be making an explicit statement as to whether you are adopting AASB 9 hedging or if you are continuing to apply the hedging requirements of AASB 139. Whilst the adoption of the new hedging requirements may not have any impact on your hedging strategies, the statement should be made so that the accounting policy is clear. Finally, you should include a table that reconciles the old classification of your financials to their new assets to their new classification under AASB 9. This then brings us to our new ongoing disclosures. First, if you're a financial institution or have complex impairment provisioning, there is going to be some significant new impairment disclosures required. These are not likely to be significant for most corporates though, and when we looked at the December financial statements, very few corporates had in fact expanded on their impairment disclosures greatly. The second area of new disclosures relates to hedge accounting and will be relevant for everyone who has hedges. The table on the screen is an extract from Example Public, our illustrative financial statements, and it is one of the new tables that needs to be included in your hedging disclosures. It requires some very detailed specific disclosures around how you do your effectiveness testing and how the amount in the cash flow hedge reserve relates to each type of hedge. It's going to take you some time to collate this information, and it may not be information you regularly access and track. Therefore, it is essential that you start looking at how you're going to pull this information together. As these are new ongoing disclosures, it isn't worth investing time and resources in setting up proper systems to do this, rather than just relying on back-of-the-envelope calculations for this year end. Now let's look at the disclosures for the new revenue standard. Part of the reason AASB 15 was issued was due to a perceived lack of disclosures around revenue under the previous standards, even though for most entities, revenue is a key line item in your financial statements. Therefore, there is an expectation by ASIC that disclosures around revenue are going to increase even if you have no change in your revenue recognition profile. We have actually already seen ASIC asking questions of entities that are holding back and not fully disclosing under the new revenue standard. The purpose of the revenue disclosures is to tell your entity's revenue story. That is, give a holistic view about how the business operates and recognises revenue. Similar to discussions we were just having on AASB 9, revenue accounting policies will need to be updated even if there is no significant change in the outcome, as the way you've got there is different. There are a few simple things to check. For example, you want to make sure you talk about recognising revenue when control passes and not when risks and rewards transfer. That is an out-of-date concept. Plate disclosures that are cut and pasted out of example accounts are not going to be acceptable under this new standard. You need to tailor your disclosures to your entity's specific circumstances, including translating those generic terms such as transfer and control to practical, tangible terms that demonstrate when control passes in your circumstances. For example, a miner might say something like that revenue is recognised when the ore is loaded onto a ship, as that is the point at which it is deemed the customer controls the ore. It's also expected that you will explain your billing cycle relative to the revenue recognition. That is, why do you end up having contract assets or contract liabilities? It may be as simple as saying, we bill our customers quarterly in advance for our services, which results in a contract liability that is recognised as revenue straight line over the quarter as we provide the services. Along with updating your accounting policy, you should also consider whether you need to update your significant judgments and estimates. This is probably going to be if you have variable consideration, have overtime revenue recognition, or just complex estimates of standalone selling prices. So, on top of all those explanations that you've provided, there are also new quantitative disclosures, which realistically are likely to have a big impact on entities with longer-term contracts. Some of the key disclosures that you now need to include are things like you now need to quantify any amount recognised as revenue in the current period that actually relates to work performed in a previous period. This will include any adjustments to variable consideration estimates, or even just when there's been a change in your measure of progress. For any open contracts that you have at reporting date, you need to quantify the revenue that you expect to recognise in future periods in relation to these contracts, if the contracts are longer than 12 months. You may have had this discussed as a backlog disclosure. You will really need to think about how you'll take into account things like variable consideration and how you're going to constrain that in coming up with this disclosure. It's not straightforward. Finally, we discussed explaining why your billing cycle gives rise to contract assets and contract liabilities, but you also need to provide a quantitative reconciliation of the movements for those accounts as well. Again, these disclosures are all going to take time to gather the information for and tailor appropriately, so please don't leave them until the last minute. Finally, let's talk about the disclosures required for the new leasing standard. These disclosures will depend on whether you are a year-end or half-year reporter. If you are a year-end reporter, this is your final set of financial statements prior to the adoption of AASB 16. Therefore, the main thing you need to be aware of is ensuring that your lease commitment note is comprehensive and accurate, as you will need to reconcile between this lease commitment note and your initial recognition of leases under the new standard. And as discussed in previous webinar, ASIC have very strong views that the standards on issued but not yet effective disclosures should be quite detailed in these financial statements, including the quantification of the impacts. Whilst we strongly encourage you to quantify the impact, realistically, if you're not that far advanced in your transition project, then you can't disclose a number that you don't have. If you're preparing half-year accounts, congratulations, you're already into your first financial report applying AASB 16. The principles here around what you need to disclose regarding transition is very similar to what you would have previously gone through with AASB 9 and 15. There's minimal mandatory disclosure requirements in interim financial statements, and beyond explaining the change in your accounting policy, you need to work out what is necessary to explain your transition story. At a minimum, we would expect this would include which transition approach you have taken and whether you have grandfathered the definition of the lease. Beyond that, the extent of disclosures will depend on how material you consider the impact to be. This will likely depend on whether you look at the impact on total assets, which is potentially significant, or the impact on net assets, which is likely to be less significant. You should also be considering whether there's been any impact on things like your debt covenants and whether it's necessary to provide any information with regards to that impact. So there is plenty there that you will need to be thinking about as you transition to the leasing standard. Before I finish up with you today, I just want to touch on the FRC Agenda decisions. For those of you who are unaware, FRC Agenda decisions arise when there is an issue that is taken to IFRIC, but once they discuss it, they don't consider a new interpretation is necessary because they think it's clear within the existing guidance as to what the accounting treatment should be. They will then release an IFRC Agenda decision. Recently, it's become evident that the agenda decisions have the same force as an interpretational standard. On the screen, you see all the agenda decisions have been finalised since the start of this year, so you can see that IFRIC's been quite busy. There's a couple that we should probably take note of. Firstly, the application of the highly probable requirement when a specific derivative is designated as a hedging instrument. I know it's a bit of a mouthful, but if you do work in the energy space, then you should be aware of this decision as it significantly impacts your ability to use load-following swaps as hedging instruments. Another one to note, especially for any constructors who are out there, would be the overtime transfer of constructed goods. If you are recognising revenue over time on, say, a building construction, the agenda decision clarifies that it is not possible to capitalise borrowing costs into the building, and instead they would need to be recognised immediately in the income statements as a finance cost. So with all these agenda decisions, there is no mandatory application date and some grace period is expected for people to update their policies and processes. However, it's not expected that these should be overly complex to implement given their typically niche nature. Based on the volume of agenda decisions that are being reached by IFRIC at the moment and their new elevated status, I would highly encourage you to stay on top of any future developments. IFRIC meets every couple of months and their next meeting is scheduled for mid-June. So overall, if you look beyond the 3 new major standards, there's still a lot happening that you're going to need to think about as you head into this reporting season. So I wish you all good luck. And with that, I'm going to hand over to Julie to talk about hot topics.
Thanks, Kristen. So our work with companies have highlighted 2 hot topics that we'll discuss with you today. Not surprisingly, our topics relate to the 2 major new standards, revenue and financial instruments. The first topic is accounting for revenue contract costs. The new revenue standard addresses 2 types of contract costs, incremental and fulfilment costs, and outlines the accounting treatment for such costs. Incremental costs are costs we incur to obtain the contract, while fulfilment costs are the costs incurred to fulfill or complete the contract. So today we're going to focus on fulfilment costs. Specifically, when can these costs be capitalised and how the amortisation of these costs should be presented in the profit and loss. Fulfilment costs can take various forms, but whether they can be capitalised depends on whether they meet the capitalisation criteria under the revenue standard. So to bring this to life, let's go through an example. So in our example, we're going to consider setup costs and whether they can be capitalised. We have Specialty Parts who enters into a contract to produce customised parts for its customer, Tech 1. Before production begins, they incur some costs. Firstly, to develop an enterprise resource planning or ERP system. There are costs to train employees and then also to migrate the customer specifications onto the platform. So how should Specialty Parts account for these setup costs? Well, the ERP system is capitalised as an intangible asset under the Intangible Asset Standard, as it is Specialty Parts intellectual property and can be used to manage future projects for all customers. The employee training costs are expensed as Specialty Parts has insufficient control over the economic benefits arising from its employees, as essentially they can leave at any time. So what about the migration of Tech 1's data onto the technology platform? Well, these costs they are not captured by other standards and meet the fulfilment capitalisation criteria, which are firstly, they relate directly to the contract as they are migrating the customer's data. Secondly, they enhance the platform of Specialty Parts so that it will be able to satisfy performance obligations in the future to produce parts. And thirdly, the costs are expected to be recovered over the life of the project. And so these costs would be able to be capitalised under the revenue standard as fulfilment costs. Well, let's look at a second example, this time around mobilisation costs. So in this scenario, we have Thor Limited, who enters into a contract to construct an office building for a customer, Valhalla Co. The company incurs mobilisation costs to firstly bring heavy equipment to the building site, and secondly to relocate employees to the building site. So how should Thor account for these mobilisation costs? What do you think? Well, we'll bring up our first polling question now. So once again, we look at the costs and determine they are directly related to the contract. They will be used to satisfy the entity's performance obligation to construct the building, and they are expected to be recovered. And so therefore, they would be capitalised. For the cost to relocate employees to the building site, well, similar to our first example, they are expensed as the company has insufficient control over the economic benefits arising from its employees, as once again employees could leave Thor at any time. So now that we've determined which costs are capitalised, the standard talks about when and what period you amortise costs. So while the standard does not specify which line item the amortisation of these costs are presented, we believe including these costs in operating expense, which would be within EBITDA, is a better reflection of the nature of these costs than including them in amortisation expense, which is excluded from EBITDA. This would also be more consistent with how these costs are have been presented to the market previously. We generally find that fulfilment costs are typically costs of sales, while incremental costs are typically related to marketing or selling costs, and would be presented as such. So our other hot topic relates to the new financial instrument standard and focuses on expected credit losses, or ECLs. More specifically, we're going to talk about ECLs relating to trade receivables. So you may recall that the standard, or be aware that the standard offers a simplified approach for trade receivables, contract assets and lease receivables. In fact, for trade receivables and contract assets without a significant financing component, an entity must use the simplified approach. This will generally include those receivables and contract assets that are due in less than 12 months from initial recognition. And we found that most corporates would be in this space. The simplified approach is used, when the simplified approach is used, provisions are based on a lifetime expected losses. So now that we've established that we must use a simplified approach for trade receivables, many companies are asking, well, then why can't I just keep on doing what I have been doing before the new financial instruments standard has came in? So the response to this is what Kristen highlighted earlier, that the new standard has new principles for estimating credit losses. The impairment model in AASB 9 is an expected loss model, which means that it's not necessary for a loss to occur before an impairment loss is recognised. So as a result, all financial assets will generally carry a loss allowance. So with this in mind, and with this knowledge, we've had a lot of questions from clients with smaller trade receivables portfolios asking, well, how can they go about calculating ECL provisions? In particular, companies may have looked into the standard and seen reference to practical expedients with the example of a provision matrix provided, a matrix that may look something like what is on your screen at the moment. And even this seems to be too complex a calculation for their scenario. So is there another simplified approach to calculating a loss allowance? Well, the good news is possibly yes. If you are an entity that has a simple portfolio and can show that there are shared credit risk characteristics across your portfolio, then there is an easier model to apply, and that is a single loss rate approach. So what do we mean by shared credit characteristics? The shared credit risk characteristics could include the aspects such as similar credit risk ratings, consistent age and remaining term to maturity of receivables. Could be that you're in the same industry that operating in, or similar invoice amounts, or if there are limits to each customer, similar limits for each customer, and also operating in the same geographical location. So with this bit of background, let's look at a simple scenario. So here we have Wholesaler Co. that operates in a single geographic location and sells products to a single customer type. Wholesaler Co. has a portfolio of 100 trade receivables with an average monthly receivables balance of $1 million and wishes to apply a single loss rate approach for measuring ECL. So given that Wholesaler Co. has a simple portfolio and can show that there are shared credit risk characteristics across its trade receivables portfolio, it is able to come up with a single default rate for the entire portfolio of receivables. So how would it go about calculating the overall loss rate? So we're going to get a bit detailed here, but hopefully you'll be able to follow along with the table that's on the screen. We'd start by taking the average monthly receivable balance. So we're using a monthly average as this will take any seasonality or other lumpiness of receivables into account. We then consider normal payment terms, and in this example, it's 60 days. So this results in turnover of receivables on average 6 times a year. This means that over the year, Wholesaler Co. would have originated just over $6 million in receivables, and you can see the basis for the calculation in column C. Wholesaler Co. would then calculate its average annual write-off of receivables over, say, the past 3 to 5 years, and in this scenario we've seen that this is $200,000. So the period of 3 to 5 years is not specified as a requirement. The purpose of the period is just to ascertain a period that is reflective of the entity's experience. So performing the calculation, this results in a loss rate of 3.3%. So continuing on then with the calculation by applying the loss rate to the receivables balance at the reporting date gives expected credit losses of just over $61,000. So you may well be thinking, hang on, doesn't Wholesaler Co. need to take into account forward-looking information? The loss rate we've just calculated appears to be based on historical information. So Kim, I think that you have some perspective to share on this.
Yes, thanks, Julie. Technically, wholesale does need to consider relevant forward-looking information. However, as the payment terms for receivables only 60 days, in wholesale's case, it's a relatively short window into the future that needs to be considered. In most instances, we would not expect there to be a material adjustment to the loss rate of 3.3%. It wasn't that we calculated. However, wholesalers should assess the information about current conditions and document its considerations relating to relevant forward-looking information.
Thanks, Kim. So just a reminder that this is a very simple approach and may be suitable in situations where the portfolio of receivables is straightforward and there's not significant diversity in the age profile. This is important to remember because otherwise you will need to use a more complex calculation. The portfolio of receivables that you are assessing for impairment needs to have shared credit risk characteristics in order to apply this approach, or you could also stratify your portfolio into a number of groups and the calculation be applied across each group. So that brings us to the end of our hot topics, and I'll now hand over to Ben.
Thanks, Julie. As Kim mentioned earlier at the beginning of the webinar, we're definitely expecting an increased level of scrutiny of both companies and taxpayers as a result of increased ASIC activity and also the ATO focus on tax transparency. In this regulatory update, we are going to look at these issues as well as some other changes in regulations that may impact your reporting.
Firstly, to financial statement surveillance. You'll see here on the screen the outcome of ASIC's most recently reported surveillance results from last year. The chart shows the areas where inquiries were made, the percentages showing the amount each issue represented of total inquiries. The results for the December review are expected to be issued shortly. These findings from ASIC's surveillance were largely consistent with ASIC's previous reports, with the top three remaining the same. However, interestingly, asset values and impairment have returned to overtake revenue as the major area of inquiry, representing more than 1/3 of ASIC's concerns. Let's dive a bit deeper into the top three. Firstly, asset values and impairment testing. Might seem repetitive, but this continues to be a perennial area of ASIC concern. Not only is ASIC narrowing in on this area in its financial reporting surveillance, but also when it conducts its inspection of audit firms. In these cases, it's identifying these as issues. In terms of revenue recognition, consistent with what Kristen mentioned earlier on, there is a focus on disclosures on the new revenue standard. ASIC has asked questions on how entities are identifying and disclosing differences between the previous revenue accounting and the new revenue standard AASB 15. ASIC is making inquiries of entities on the accounting for income tax, including the adequacy of tax expense. It's going to be interesting in the context of the new Interpretation 23 on uncertain tax positions as to what further questions ASIC might focus on in this area in its 2019 reviews. And with that, I'll now pass it back to Kim, who's going to take us through some of ASIC's key focus areas as we approach June 2019.
Which leads us to ASIC's focus areas for the upcoming reporting season. The areas shown here are the areas we expect ASIC will focus on in 2019 based on our experience. We do expect ASIC to release its official areas of focus media release in the next month to confirm this. We note that in December 2019 reporting season, ASIC indicated that it would place greater emphasis on the impact of new accounting standards, perhaps not surprising given revenue and financial instruments are becoming effective for the first time, and also they're considering some of the issues Julie raised earlier in her hot topics section. Not to mention the need to disclose the significant impact of the Leases standard, changes to the conceptual framework and the insurance standards that are effective in upcoming years. There's also been a renewed focus on non-IFRS disclosures and whether they are appropriately identified and reconciled to the statutory amounts. Moving on to some new guidance from the ATO. In April, the ATO released its long-awaited guidance relating to its measure to require certain significant global entities to lodge general-purpose financial statements at the same time as it lodged its tax return. You probably know if your company is caught by this, but it is of particular importance to subsidiaries of foreign multinationals that have not lodged general-purpose financial statements before. This slide reminds us of how long a journey it has been, and we are already past the second year of implementation, and guidance is still being issued by the ATO. The guidance principally seeks to clarify the requirements and options available to small proprietary companies to expand what accounting principles the ATO considers to be commercially accepted accounting principles, and to clarify the term financial year most closely relating and corresponding to the income year. So I'll explain the first two matters and leave the other matters for you to read up on in our updated guidance on the topic, which is available on our website. The updated guidance uses the four-scenario table that is included in the September 2017 guidance and provides a helpful scenario-based guide to what your requirements and available options are if you end up in the bottom left of the decision tree. That is, if you are required to give a general purpose set of financial statements to the ATO. In its 2019 guidance, the ATO clarified that where an entity falls within Scenario 2, a general purpose financial statement prepared in accordance with another country's local accounting standards, even if those local accounting standards are based on IFRS, is not acceptable. This means that an entity within Scenario 2 cannot lodge an overseas parent's consolidated general purpose financial statement, for example, those prepared in accordance with EU IFRS. If you are otherwise relieved from preparing financial reports by ASIC because you are a small proprietary company that is foreign controlled and are neither part of a large group or have a foreign parent that lodges consolidated financial statements with ASIC, which are prepared in accordance with accounting standards applicable to their home country, then you are in Scenario 3. This means that your financial statements can be prepared in accordance with AASBs, or alternatively in accordance with commercially accepted accounting principles. So what exactly is commercially accepted accounting principles? Well, the ATO has listed a number of specific standard frameworks, including IFRS and US GAAP. It has also provided some referencing to guidance where the standards listed do not apply in your circumstances. Well, as a knowledge check, we are now going to have a polling question to test our understanding of the impacts of the changes. Entities are relieved from preparing financial reports by ASIC because they are a small proprietary company controlled by a foreign company that is not part of a large group. They will be allowed to lodge financial statements prepared in accordance with commercially accepted accounting principles rather than Australian accounting standards. Okay. So another recent reporting change that has occurred was that the government issued some regulation on the 5th of April to change the reporting thresholds for companies for the first time since 2007, with the intention to reflect the nominal economic growth since that time and to ensure that financial reporting obligations are targeted at economically significant companies while reducing the costs for smaller sized companies. As a reminder, the test is important as large proprietary companies are required to lodge an annual financial report, a director's report and an auditor's report with ASIC. Small proprietary companies have no such requirement to lodge unless they're directed to do so by ASIC or by more than 5% of their shareholders and are generally required to keep sufficient financial records. Okay. So what are the current thresholds? They're here on the screen for you, and I'm sure you're very familiar with them. As a reminder, a proprietary company is large if it meets 2 of the 3 thresholds at the end of its financial year. Otherwise, it's small. A reminder also that the thresholds are based on consolidated revenue, gross assets and employees. So even if a company does not prepare consolidated financial statements, for example, where it prepares special purpose financial statement but chooses not to consolidate, it is still required to make the assessment on what the numbers would have been if the group was consolidated. So what's changed? Well, for For years beginning 1 July 2019, the changes doubles the thresholds for determining whether a company is a large or small proprietary company for a financial year. So a company will only have to lodge if it meets two of the new thresholds. It is expected that approximately one-third of proprietary companies that lodge audited financial statements with ASIC in the 2017 to 2018 financial year will no longer be required to lodge their financial reports in future years under this increased threshold. So this may be good news for some. However, it's still important to note that small proprietary companies that are foreign controlled are still required to prepare and lodge an audited financial report with ASIC, subject to certain exemptions. In addition, as we just covered, a small proprietary company may be required to prepare general purpose financial statements under the ATO guidance if they are part of a significant global entity. So now let's look ahead at the upcoming changes. We've covered the new standards that become effective for 30 June year ends and 30 June half years, but there are a number of other standards that are issued but not yet effective. We've listed those that are effective for next year. We have covered these in previous webinars but have some updates worth noting. The Service Concession Standard, which is applicable for public sector grantors, was originally expected to be effective at the same time as the Leases Standard, and this has now been deferred until years beginning 1 January 2020. The changes in the definition of a business will make it easier in certain cases for entities to identify if they have an asset acquisition or a business combination through the introduction of a concentration test. There is a short video explaining what this means in practice that's available on the KPMG website, and we do encourage you to look at this if you are planning an acquisition in the near future. The new materiality standard amends the definition to include a consideration of whether obscuring information could reasonably be expected to influence decisions that primary users of general purpose financial statements make on the basis of those financial statements. Looking further out, the insurance standard has had an extension in its effective date to years beginning 1 January 2022, which will give insurers more time to prepare for this new standard. And there's a minor amendment to the sale of assets from an investor to its associate or joint venture, which with its date has also been deferred. We'll next have a look at two changes from the AASB that's close to being finalised as amendments to these requirements are in relation to classification of financial liabilities and deferred taxes. Preparers of financial statements sometimes find it challenging to interpret whether or not financial liabilities should be classified as current or non-current. This amendment is intended to clarify when the holder of a convertible note has an option recognised as an equity component by the issuer, that the terms of the equity component do not affect whether the issuer classifies the liability component as current or non-current. It also clarifies that for instruments classified as liabilities, the transfer of the entity's own equity instrument is regarded as a settlement of that liability for the purposes of classifying it as current or non-current. The amendment to AASB 112 is intended to bring clarity to the treatment of assets and liabilities that arise from a single transaction, and this is particularly important in the context of the new leasing standard and the question of whether the initial recognition exemption applies where leases are brought on balance sheet for accounting purposes by lessees, but do not have a tax base for tax purposes. Do not expect a significant change in practice as a result, although the technical justification for booking deferred taxes and deferred tax assets and liabilities will be clearer, as there were mixed views as to why it was appropriate to not book them previously when entering into a lease. In terms of what's left on the short-term public sector agenda, we have the exposure draft that is expected on fair value measurements for public sector entities. We're expecting that in the third quarter of 2019. And the other main thing to actually note is that there are significant changes, as expected, to the conceptual framework. We won't be revisiting everything today, but we do want to highlight what has changed. The AASB in its September meeting has decided the project in the Australian context is going to be focused initially on for-profit entities. And the reason for this is ongoing discussions in relation to reporting requirements for not-for-profits as it relates to the ACNC legislation review proposals. So what may be of interest to NFPs, however, is that the AASB is issuing an exposure draft on the definition of a not-for-profit, and this will be important in identifying which entities, which framework entities should be following. So how far has the AASB progressed in its for-profit project? As part of Phase 1, the AASB issued a fatal flaw draft in February for its conceptual framework for Tier 1 and those voluntarily reporting compliance with IFRSs. This means that assuming that the changes are finalised, the new revised conceptual international framework will apply for those entities for years beginning 1 January 2020, while Tier 2 and special purpose financial statements continue to apply until Phase 2 is complete. Phase 2 will be where the most significant changes will occur with the end of special purpose reporting as we know it. This will be a significant change for many entities in Australia. The implementation date is yet to be finalised, but it could be as early as years beginning 1 July 2020. An exposure draft on Phase 2 is expected in the second half of 2019, so please stay tuned. The AASB last week also proposed to issue some changes that will impact entities preparing special purpose financial statements in the meantime, requiring a disclosure of whether subsidiaries are consolidated and if not, the reason why, as well as other disclosures around accounting policies applied.